Hello everyone, welcome back to RR Corporates. Now we are discussing on common errors, common mistakes in financial statement of companies, and in view of the accounting standards and Companies Act provisions, Companies Act 2013. So these financial statements are backbone of the corporate transparency and financial integrity. They provide stakeholders, including investors, regulators, and management, with a clear picture of company's financial health and operational performance. However, what is happening, many of corporate entities unintentionally make critical errors while preparing or presenting their financial statements. These mistakes can lead to misrepresentation, misinterpretation, and audit qualifications, and even penalties for non-compliance. So in this video, we'll walk you through frequently observed errors and the applicable accounting standards, relevant provisions of Companies Act 2013, and the impact, what would be the impact of these mistakes on financial reporting. So let us now examine each of these common errors which we observe. We'll discuss in detail what about these non-compliance and the penalties and common errors. So the first would be the misclassification of capital and revenue expenditure. This is what the common error we observe in many cases as per the accounting standard AS10. Property, plant and equipment capital expenditure should be capitalized as part of the asset cost. Repairs and maintenance should be charged to revenue. But the error which we see in many cases, companies often misclassify routine repairs or maintenance as a capital expenditure or vice versa. So this would impact overstatement or understatement of fixed assets, incorrect depreciation charge, and misleading profit and loss account. This would be the impact because of this. And other mistake we observe, incorrect depreciation calculation. So the provision as per the Schedule 2 of the Companies Act 2013, depreciation must be calculated based on the useful life of assets as prescribed and using suitable methods such as SLM or WDV. But the error which we observe is depreciation is often calculated using outdated rates or without updating useful life. This is what generally we see in many cases. So what would be the impact in over and under depreciation, misstated profits and asset values, increased risk of audit qualifications. These are all the impacts because of these errors. And another mistake we could see, the premature revenue recognition. We will see the provision as per AS9, revenue recognition. Revenue should be recognized only when significant risks and rewards are transferred, and there is a reasonable certainty of collection. The error we'll see, the revenue is recognized before delivery of goods or completion of service. So the impact is overstatement of revenue and net profits, misleading financial results. And another error we will see, the non-disclosure of related party transactions. In many cases we will see this, but as per the provision AS18, related party disclosures, all material related party transactions and relationships must be disclosed. Then the error, failure to disclose loans, guarantees, or transactions with related parties such as directors, subsidiaries, or associates. So what would be the impact? Lack of transparency, possible conflict of interest, regulatory violations. And another error, we'll see the omission of contingent liabilities. As per AS29, the provisions, contingent liabilities and contingent assets, such liabilities must be disclosed unless the possibility of outflow is removed. So the error, significant legal or tax related contingencies are omitted from the financials. The impact would be incomplete risk reporting, misleading presentation of financial position. And another error we will see, inadequate disclosure of accounting policies. As per accounting standard 1, disclosure of accounting policies. All significant policies must be disclosed and consistently applied. So the error is the changes in accounting assumptions or methods. Example, inventory valuation or depreciations are made without disclosure. The impact is loss of comparability, reduced stakeholder trust. Another error we'll see the mixing prior period items with current year figures. As per AS5, net profit and loss for the period, prior period items and changes in accounting policies. Such items must be disclosed separately. But the error will see that previous year adjustments are included in the current year profits without separate disclosure. The impact would be distorted current year performance, possible audit observations. And another error, recognition of default tax asset without profitability assessment. Without profitability assessment. You see, accounting standard 22, accounting for taxes on income. So deferred tax asset DTA should only be recognized when there is a reasonable certainty of future taxable profit. The error DTA created based on the past losses without assessing future profitability. So the impact would be overstatement of assets, likely reversal in future periods, potential audit qualifications. Another error, we'll see the premature recognition of government grants. If you see, as per accounting standard 12, the government grants, a grant can be recognized only when there is a reasonable assurance of both compliance with conditions and actual receipt. The error is grants are recorded before satisfying conditions or receiving confirmation. The impact, inflated income, increased scrutiny during audits. And one more error we'll see, the lack of provision for warranty or after sale services. And you observe the provision, companies must recognize provisions for known obligations like warranty cost. The error in financials, no provision made despite historical trend of warranty claims. Impacts, understand no liabilities. So the impact will be on the liabilities, understated liabilities, misrepresented profitabilities. And another error we'll see omission of KMP disclosures. As per AS18, transactions with key managerial personnel, including remuneration, loans, and benefits, must be disclosed. But many financials will see benefits or transactions with non-executive directors or their relatives are not reported. The impact is compromised governance, risk of non-compliance. And one more, asset retirement obligations, ARO not provided. As per AS10, provision for dismantling and restoration of costs, ARO must be included in asset cost. ARO not provided for warehouse, plant site, etc. In many of the financials, you see that ARO not provided for what? Warehouse and plant sites. The impact is again understated assets and liabilities, potential financial shock in future, and non-provisioning for employee benefits provision. So non-provisioning for employee benefits. As per accounting standard 15, employee benefits, gratuity and leave encashment must be provision based on actuarial valuation. The error is provisions based on management estimates or no provision at all. So the impact, understated liabilities and expenses, may attract qualified audit opinion, and incorrect revenue recognition from loyalty. Incorrect revenue recognition from loyalty programs. AS9, revenue from sale transactions that include future obligations like loyalty points must be deferred until redeemed. Error is entire revenue is recognized upfront, ignoring deferred obligations. This error we'll see in financials. So the impact is inflated current period profits, a reversal of income in future periods. This would be the impact. And one more, failure to test tangible for impairments. As per AS26, intangible assets. So assets must be tested annually for impairments. Error is skipping annual impairment test. The impact overstatement of asset value, delay in recognizing losses, and one more error, non-preparation of cash flow statements. Non-preparation of cash flow statements. AS3, as per AS3, preparation of cash flow statement is mandatory for companies unless exempted, small or dormant companies. But error, omission of cash flow statement in financials for many companies. The impact, incomplete financial statement, non-compliance with Schedule 3 of Companies Act 2013, audit qualifications likely. So, even minor errors in financial reporting can lead to significantly regulatory, audit, or reputational consequences. So, this session has covered some of the most common mistakes observed in corporate financial statement, ranging from accounting misclassification to non-disclosure of crucial information, along with the relevant accounting standards and legal provisions. So the corporate professionals, accountants, and auditors must proactively address these areas to ensure transparency, improve compliance, and provide accurate information to stakeholders. Proper adherence to standards not only enhances financial credibility but also builds long-term trust with investors, regulators, and the public. So if you found this session, this video valuable, do like, share, and subscribe. Stay tuned for more expert insights into corporate compliance and financial reporting. We have two channels, RR Corporates and RR Legal Talks. Please do subscribe for two channels, RR Corporates and RR Legal Talks. And also hit bell icon so that you will not miss any of the latest updates. Thank you.